I actually think bootstrapping is something more people should consider. You have a lot more control over your destiny.
First and foremost, there is no fun in fundraising right now. I think this is probably the hardest fundraising environment for both founders and then funds themselves.
But the thing that I've learned the most in the pre-seed and the seed stage of pre-series A is like really refining what problem are you solving, who are you solving it for, what product you need to build to solve that problem, and what promise are you unlocking.
Welcome back to VC Unfiltered. Super excited to have you here. As always, we had our demo day in mid-October. And so one of our missions here at Pegasus is always moving the needle on founder failure. And so we always like to include an education piece with any event that we end up doing. And so we brought to you a great VC panel with Lanzi. He is the managing director of the Stubbs Preccelerator, one of our esteemed partners and people that we love working with. Please take a listen. Super interesting chat.
My name is Lanzi. I'm the managing director of the Preccelerator program. I've been in this role just under 5 years. It's hard to believe how fast time goes. Prior to that, I spent 13 years as the executive director of the Los Angeles Venture Association. And during that time, I get to know some of our investors that are on the panel today. And we're going to focus not on our typical kind of venture panel talking about what do you invest in and why? But we're going to talk about why did you start a fund? Why are you working in venture? What is exciting about that for you? And how do you see yourself as part of the ecosystem, not just as an investor, but a participant? I'm going to start with Petra because I know her the best. She was on the board at LvlUp with me several years ago. So you went from product to banking, to venture. Why?
Petra Griffith, I'm the founder and managing partner of Wedbush Ventures. We invest in pre-seed and seed stage companies. So my journey, and it's almost like Len was giving me my intro speech every time I meet with a founder. So this is great. I'm a former product manager. I started my career actually up in the Bay Area as a product manager. It was actually, I was hired as a person to help build out a company. The title product manager didn't exist back then. I kind of fell into that role. It was at that role of working with the engineers, understanding strategy, understanding customers, making that translation. I think the product role has changed a lot. I actually don't understand a lot of product management today, but it's that role of like that translation layer and that building. And I always loved that building. And then I went to bigger tech companies. I went into banking, and then I left Netflix in 2018. I did some consulting, and I was like this is fun, but I want to do more than just consult. And that's what brought me into venture. And that's why we invest in pre-seed stage companies, pre-seed to seed, pre-series A, finding product market fit. Like that's my sweet spot, and that's what we really love to work on. And that's a team. Ashley is on the Zoom. Also a former product manager, and Melissa, our venture partner, is also kind of a former product manager and operator. And that's kind of the lens that we bring to investing, and that's what makes us passionate about working with founders who are solving really kind of hairy, big transformational problems in those early, like kind of before you kind of hit that, like, I understand who I'm selling to, and this is why I'm selling to them, and this is what my product is, and this is why it's repeatable. It's like that messy stage and before that we get excited about.
I'm going to stick with you just for a second here. Wedbush, kind of a household name in the investment world. Why did they start a venture firm?
Yeah, and Wedbush Ventures is a separate entity. We are anchored by Wedbush Capital. Wedbush Capital is the owner of Wedbush Securities, which is a financial services firm, broker-dealer, investment banking, wealth management, clearing. We're a separate entity. We're not strategic. They backed me because this was an asset class that they wanted to participate in, and they wanted to find a manager, someone who could start the fund, run the fund, who had expertise in this space. And so for them, it was an investment decision and a partnership, which has been great because I get to run the fund. They are the anchor LP. They're not the only source of funds. So we run very much just like any other venture fund. But we have the access to Wedbush, the Wedbush kind of network, which is great. So everything from the investment bankers to the research analysts, doing due diligence, making introductions. It's a network and community that I can leverage, which is kind of the best of both worlds, if you ask me.
Awesome. Thank you. Let's move over to Andrew. Andrew, why don't you go ahead and introduce yourself and talk about a little bit about Alpha Edison, but talk about your journey into venture and how you got into it and why you're staying in it.
Hi, everyone. I'm Andrew Darcovich. I lead investor relations and capital markets at Alpha Edison. We're based in Westwood here in LA, primarily focused on seed A and B businesses, really across sectors. I started off my career moving to New York from Vancouver, Canada, to join Goldman Sachs, spent the better part of a decade there before moving out first to growth equity and then after that venture capital. For me, it was really getting closer to the innovation ecosystem. There's this great book by Clay Christensen called The Innovator's Dilemma, where many large institutions, large organizations really are slow to innovate, right? If markets are hurt, the first thing they cut is R&D spend. And that gives rise to the opportunity for venture capital. And so once I kind of clued into that early on in my career, it was just taking the steps to get closer. Initially started angel investing, like I think a lot of people in this room do, to then jumping in with 2 feet, focus more on the capital side of the business. To me, the storytelling, the people, the narrative is a lot more passion-inspiring, fashion-inducing.
Super. Brandon, why don't you tell us a little bit about your journey into this wonderful space?
I've been in this space now for close to 15 years, both as a founder of a startup, and I've been on the VC side for close to 10 years, running my second fund, LvlUp Ventures, that focuses on mature seed stage companies, but overall takes this bottom-up approach to really building a comprehensive venture ecosystem where we run a lot of pre-accelerator go-to-market programs and corporate innovation programs with groups like Google and Fidelity. But kind of the antithesis of me getting into this is I fell in love with doing startups. I fell in love as someone that I like to think I have some versatility across doing different things, that this is a true space of innovation. I love working with founders, like having the ability to affect change, and it's truly incredible to watch what a lot of people create in this space. For me, it's just an absolute pleasure to be a part of it.
How much time are you spending fundraising?
Just like any startup, there is a fine balance to the raising funds and still being able to focus on all the other components of the business. I would say that the balance is probably 20% on the fundraising and 80% on the support and continuing to build this bottom-up ecosystem where all of the dots connect in a meaningful way, and we can continue even as a fund to expand, scale, hopefully to a massive level.
First and foremost, there is no fun in fundraising right now. I think this is, and Petra, you can comment on this as well, probably the hardest fundraising environment for both founders and then funds themselves in our careers. My full-time job is fundraising, both for our portfolio companies and then also for our fund itself. 100% of my time is oriented around it, but I think the biggest lesson or the biggest success for a lot of GPs and fund owners is you're always fundraising, right? Whether it's an entrepreneur, you're pitching your story, or whether it's an LP, you're pitching your story. It's events like this, you're telling your story. And so always being fundraising, it kind of becomes part of the job and just check the box every single day versus there's a point in time where you can measure 20% of your time as fundraising.
As you go, same way with a startup, it gets easier. Even in this environment, the more that you do to put yourself out there, whether it's an event, whether it's putting on your own event and curating and building that audience, if there's a will, there's truly always a way, even in these types of environments.
Is there anything new from a technology standpoint or a process standpoint in looking for LPs and bringing LPs into a fund? Has anything changed over the past 15 years in doing that?
Two things. So I think one, there's been a lot more interest in the private asset class. From my perspective, like the potential investor group has gotten bigger. There are a lot more potential LPs. Hustle Fund does some great content around this. Like anyone is in your contractor could be your next LP, your dentist could be your next LP. I think it's actually some great content around that. So I think that the universe of people who are curious about private markets, curious about startups, that has definitely increased. So it's made it a little more interesting, but it's also hard in terms of if you want to get a fund above 10, 20 million, you need individuals are great, but it's hard to get a fund. We're limited to 100 LPs. And so it's hard to raise a fund with individual LPs. Andrew can talk a lot more about institutions. Technology-wise, I don't see much. It's still a block and tackle business, in my opinion.
I think the biggest change over the past decade, to your point, Petra, has been everyone kind of knows what venture is now. There's been this massive tailwind, I think, since the GFC, where venture became sexy and it was an up and up market. And so dealing with the fallout of that because of 2022 and kind of the damage that we did to ourselves has been eye-opening. But for context on the fundraising side, the last fund I closed was a $1.5 billion fund, your growth equity firm in 2021. The most recent fund of April of this year was $150 million. Different firms, different strategies. But this last fundraise was very painful because it is a lot of blocking and tackling, and even more so now where people have more time for diligence. It's a lot easier to do a Zoom meeting. LPs, this institutional, but also smaller individual one, are just a lot slower moving and methodical. There's no rush. The one piece of advice or the one thing that's worked well is creating that scarcity, create demand, right? And I think it goes to building that community, building those trusted partners, trusted relationships. I call it your 10 true fans early on, and having that momentum and then riding that with a narrative of there's only so much time left. But wait, there's more, right? The kind of strategy has been the biggest shift. In terms of technology, there hasn't been this aha moment or light bulb moment of there's a tool where it can reach out to all these specific LPs. There's great lists, but it still requires time and energy, and ultimately in this environment, high quality relationships. I think people are everything right now, even more so than they have been in the past.
It's really a relationship business, so I don't think tools are great, once the commitment has come in and getting the documentation done, but it's gotten much more competitive. Also, the number of funds in LA, when you ran Lava, there was how many funds when you,
Maybe 60, 70.
Even that many, yeah. But it doesn't, especially
She was hoping for 6 or...
I know, I'm
well,
I don't
it depends on what you considered a fund, too.
I can count 10.
Right.
Yeah, and I think if you look at national stats, I think it's 3,000 funds. And so there's been an explosion of solo GPs and a lot in the pre-seed and seed stage. So there's been a lot more of these sub $20 million funds, which I think is actually quite interesting for the pre-seed. You see more companies getting funded actually in those early stages. It makes it more difficult when they get to Series A.
As you build a portfolio, and when we look at specific companies that are coming and asking for investment, we look for things to de-risk that, right? You want to de-risk the investment. How do you de-risk a portfolio? How do you look at the totality of a portfolio and say, how do we de-risk that? Is there any way to do that in making the math work so when you have that exit, it covers everything else? But if you could have 10 out of 10, that would be awesome. How do you get there?
I mean, with Wedbush Ventures, we recognize that the pre-seed and seed stage is risky. You just can't underwrite every risk. There's a lot you don't know yet. There's a lot how your product will change, the market will change, founder dynamics will change. We're actually, LvlUp Ventures does a lot of content around this, and we're big believers in that decision-making science of you do need diversification. And so we look to Fund 1, we had 40 companies in Fund 1. And so we think about it as a diversification in number of bets. And it is a venture law. The returns are really driven from a few outliers in your portfolio. So I'm a personal believer you need to have enough bets in your portfolio, enough chips on the table.
Yeah, I definitely think it comes with that ability to grow the portfolio. Anybody that says that as much as we'd want to have that perfect 10 out of 10 scenario, realistically it's not going to happen. At this level, pre-Series A, there's not enough data points to truly make a predictive analysis on how successful somebody could be. That's why you hear so many different groups driving home team, or there's other specific components of the business, like does this company based off our check size have the ability to scale quickly enough? If you're a follow-on smaller check, do they have enough money with what they're doing? Like if it's a marketplace and they're raising $500,000, that's going to be really hard to be successful, and it has a high likelihood that that type of company, if it's like the Airbnbs of the world, in that business model, they're probably going to be raising multiple seed rounds if they can't hit that, $10 million massive pre-seed or $30 million, sometimes which is kind of virtually unattainable in certain areas outside of San Francisco.
The most important thing, in my opinion, is setting your strategy early before you go and actually close the fund. Check size, follow-on strategy, reserves for follow-ons, and then sticking to that. So much so that we have a printout of our initial investment strategy. We put it on the fridge. It's like one of our kids' finger paintings.
Yeah, and where can you really add value, like opportunity costs, like, where are you able to really make a difference, and where someone else may be better suited to make a difference?
Thinking about investments that you've made, is there a particular lesson you can pull out of that investment for something that didn't go as planned?
I mean, I would say there's definitely quite a few previous fund being purely acceleration focused. I would say it's the handful of the hardware investments that we made. I'm not going to give any specific names, but handful of hardware investments that are a little bit more capital intensive. As an accelerator program, giving them $150,000, you're not going to move the needle much. Now, granted, even going back to that same analogy of like the marketplaces, if they only have a few $100,000, your $150,000 is not going to move the needle much. And I would say that some of those types of companies, although intriguing as they were, they're like shot in the dark bets just based off of the resources they have to work with.
At that point, were you betting on the technology and the company itself, or were you placing the bet on the founder?
It's a combination of the founder and the technology itself. Some of these that had interesting patents, trying to think if this completely fails, is there at least some sort of recoup way out of this? But as you're playing with, especially from during acceleration, where we were taking 90 companies a year at Quake, you're making a lot of bets. So some of these, you're purely taking that swing for the fences and you're playing the law of averages. But if there are certain things that I could avoid, then just swinging for the fence on certain deals that probably in hindsight didn't make as much sense, I might do something differently.
As I said before, there's certain risks that you just can't foresee, and those happen, and you can't really control them. But the thing that I've learned the most in the pre-seed and the seed stage of pre-series A is like really refining. We call them the 4 Ps. It's like, what problem are you solving? Who are you solving it for? What product do you need to build to solve that problem? And what promise are you unlocking? And if you can, and those are 4 questions that companies have a really hard time answering. And so that's like kind of what we always focus on. And so like I found velocity, so that your ability to constantly be like, okay, whose problem am I solving? What is the promise that I'm unlocking if I solve this problem for them? Because there's so much you can be doing, and it's this lack of focus, or it's this like ability, or this like, you really focus on like, oh, I get it, I'm getting all these calls with these people, but they don't end up buying my product, or and so that usually is because like what you're selling them is not what they want. So figure out like where's that market pull. That's like to me what I always think about. Like you might have gone in like, I have this hypothesis, this is the problem that I want to solve because this is what I experience, and then you go and you sell it to 5-10 people, and they might take your first call, they don't take your second call, and they don't take your third call. Like that input you need to then take and then refine your strategy. So I think about velocity, taking an input, transferring that back into execution. That's kind of, you need to be able to, because that's something we really spend a lot of time thinking about, and does the founder have that capacity to have that framework of like, here's what I want to approve, I'm going to execute, take the input, and then refine, and then move forward again. I've also learned, like, oh, this person lives at XYZ impressive company, like that ultimately doesn't matter, and we really look at the execution. Like, are they willing to run through walls? We just spoke with a company this morning, one of my first companies I invested in, and I probably had written them off already, but like they kept on iterating, they kept on listening to their customers, and they're like, they're just like so close to being, we'll see, but like I think I'm impressed with where they've been, and they've just kept on pushing through.
They have the factor.
Yeah, exactly. Yeah.
Why is Los Angeles a great place to start a company? And why is Los Angeles a good place to invest?
I mean, I'll take this one because I am very bullish in LA, and the reason I went into banking was actually because I wanted to help develop the LA tech ecosystem. I started my career up in the Bay Area, so I feel like I have an interesting vantage point where I spent most of my career in the Bay Area or for Bay Area-based companies, and then I've also lived here for almost 20 years now. I really like LA because LA, one, is diverse, and two, it's more applied in a good way. Like, people are they're very problem-focused. The founders are just kind of gritty, heads down, and have this unique lens to a problem, and that to me always lends to an interesting solution, which is market defining and market changing. That's what makes me bullish about LA.
I came out here in 2018, opening our first Quake office. It's changed so much. It was Silicon Beach, and everything was kind of, in this Santa Monica, Venice area. And since then, it's grown so much where, as much as LA is rich in culture, every single area of LA has something when it comes to innovation, whether you're in Century City, whether you're in Culver, whether you're in South Bay like me, which feels like a different country in a bubble. In El Segundo, you have all these major corporations. There's a lot of innovation out there. Every single rich cultural area has something different to offer. And just bringing all of that stuff together, I feel like LA has become such a great alternative to that very tech-focused Silicon Valley, San Francisco area.
What's changed over the past, say, 15 years from maybe when you first got here to build companies and invest in companies to today? And what do you see coming down the road? Where do you think it's going?
I feel like when I first got out here, it was during this interesting transition where you started getting some of these larger companies like Snap that came to Venice, Santa Monica area, and you're kind of seeing the growth of some of these larger companies, but it was not that vertical growth from a fund standpoint. It was very much pre-seed and seed, and then how do you support them after? I think that has been one of the biggest transitions here, is this growth of funds, not just early stage, but the ability to invest up the funnel that helps keep these companies here and not have to abandon ship and go to San Francisco or abandon ship and go to New York. And where I see it going with that, LA will just continue to facilitate and adopt having all of these companies of tomorrow and keeping them here.
I think there's been an explosion of funds, both in the pre-seed and later stage stuff has been really nice to see. Minnie Ingersoll at 10110 does an LA Venture podcast, and I think she's been doing it for 4 or 5 years now. And I mean, it's 300 plus interviews she's done, and all LA-based VCs. So like that would have been unheard of 15 years ago. I just think back to 2014 or so at Lava, and it was the same. It was a much smaller community. The community has grown, and I think that's been great to see. We've had more exits. We've had more companies grow. There's been more tech talent. More tech talent is staying. The pandemic was actually, I think, really good for LA. There was a lot of tech talent that came to LA. It was a better quality of life, more outdoor space. Not all of it has stayed with the burgeoning of AI. Much of it has moved back to the Bay Area, but some of it stayed. And I just think the more talent stays here, the more, it's not only number, but also quality of startups stay here.
All right, I'll just make a comment, because I think one of the things I've observed over the past 20 years is we did not have that talent sticking around. 20 years ago, if XYZ fund out of Silicon Valley invested in you, there was almost an expectation that you were going to go to the Bay Area and build your company there if they were going to keep investing in you. And what does that do? Well, once that exit happens, now that founder is not here. That founder's up there. Any carried interest that and any proceeds from a sale that founder has that can be reinvested in the community is not here. And I think Los Angeles struggled with that through the 90s and through the early 2000s. If you look at kind of the history of venture, and there's people in the room that will remember this, I mean, our big exits of GeoCities, of Overture, created an executive team of people then that could go out and build companies. And if you look at the pedigree of people that have done that, who are now my age and older, now their kids are out there doing it. So we're building some generational entrepreneurism that didn't exist 20 years ago. And I think that's a huge change. The other thing is the pandemic has kept people here as opposed to draining our brains. Los Angeles is known to be the #1 producer of engineers in the country, if not the world, just based on the number of schools that we have here that do that. But they were all going up to Silicon Valley to work up there to New York. They're staying here now, and that's to our benefit because we get terrific founders building companies who stay here, who employ people, who exit, and then reinvest. And that's how that cycle needs to build. And because of that, I'm very bullish on Los Angeles and the economy that we're building here, both through venture and other ways. What do you see the future of venture capital, and how is the industry evolving? So what's changing within the investment community that's different, and where is that going? Because I think we've seen some huge changes in how companies approach investment because of the Jobs Act and being able to do a CF funding, a crowdfunding. How is that dynamic changing how you all invest, and do you see any trends that are going to change that in the future?
So I think one, it's cheaper to start a company now. I'm seeing a big trend towards bootstrapping. So more and more founders who are just, especially repeat founders who are not raising venture anymore, as much as they can. The other benefit of the alumni network is there are more angel investors. I just see more and more founders who are raising, it's still $500,000, $200,000 to get a company going and to get it to cash flow profitability, and they're growing it very differently, and they're just deciding not to go the venture route. I also see a lot of companies that have kind of hit a growth metric. They're at whatever, 20, 50, even 100 million in revenue, and there's kind of a question of where do you go from there. It seems a lot fewer growth dollars. You'd have a better perspective on that out there. And then just haven't been a lot of IPOs. There's a lot of companies sitting there in that like pre-IPO bucket, and so there's a lot of question about how do they exit. And you're seeing some momentum on the secondary share side there. I actually think bootstrapping is something more people should consider. You have a lot more control over your destiny. Crowdfunding, I'm personally not a huge fan of crowdfunding. It's definitely a way to go. I've seen some of my companies have raised money that way. And the reason I'm not a huge fan is it's a lot of people to manage. And I think it'd be very good if you have a consumer product and you're building kind of customers who want to be your investor. I've seen that be very effective. I found the equity crowdfunding to be less effective, but it's definitely an option.
Yeah, in terms of where it's evolving, I think it goes back to just how this is not a foreign conversation to so many people now, that when you're starting a company, and I know that I've come across, at least in the time that I've had in this space, a lot of first-time founders, it's just like, so I go to a VC to raise money. Now you've got so many people familiar with this space that whether they support early stage, whether they're family offices that have 10% or 15% or a large portion of what they're investing in, focused in Series A and above private. Outside of the crazy amount of funds that have formed over the past 5 to 10 years, there's been a lot over the past 5 years in the secondary market. There's so many different groups, and people are, whether they're interested in early stage or not, they're down to go into some of these more protected deals that are up the funnel, and there's so many different access points to get some of the ones that are the best performers that you probably want access to. So I think it's shifting in terms of the wider base of who a potential investor in your business actually is.
Great. So let's wrap up by pitching to this group why an investment from Wedbush, an investment for Edison, would be beneficial to a company. What do you offer besides money that's your secret sauce?
We're former product operators. We love the messiness of that finding product market fit. We want to be your partners in focusing on like what problem are you solving and who does it matter to and why, and be your partners through thick and thin to help you get to that stage where you're on your rocket ship, and also solving a big problem. Like we love finding like meaningful problems to solve.
There's no problem that we don't want to solve. Like we sprint in with our portfolio companies, with our founders, and the most important thing to us is not just cognitive adversity, but trust.
We have a massive ecosystem. We work with close to 25 corporate partners. All of our team are former operators, startup founders, and that have done stuff quite recently that understand it's still fresh in their brains that this takes a lot of blood, sweat, and tears. And when you're a super small team as a founder where you're juggling like 50 different things and investor just gives you money and expects you to be successful, that's not the approach that we take, especially investing other people's money. We actually really work closely with these companies on a bi-weekly basis. Some it's less, others it's much more, whether it's fundraising, but we usually come in at the end of the round. That way we can take a roll your sleeves up approach and start building on that customer and partnership base. We look collaboratively across synergistic customer bases on each company that we take, whether to make sure it's not competitive, but it's synergistic in nature.
So thank you very much. Thank you for being here today and imparting your wisdom.